Every sustained $10 increase in oil historically adds roughly 0.3 to 0.4% to CPI over time.
What's going on right now in the Middle East? It's not even about missiles. It's not about borders. It's not even about who wins the war. It's about who controls your money. My money, your money, our money. The mechanism is crisis monetization, using the war risk to justify liquidity expansion while transferring inflation risk onto the public purse. And most people are watching explosions on their screens, people dying, really heart-wrenching things, while the financial system quietly resets the rules right underneath them.
As we look at the level 2 data coming in, the institutional sell flows are spiking dramatically this afternoon. That's right.
You're being told that this is all about just the geopolitics. But geopolitics is always the cover story. Debt survival is the real story here. And by the end of this video, you'll see exactly what I'm talking about. So let's start with a short story. You wake up one morning, oil is up 9% overnight after some strikes in the Middle East somewhere, some refineries been blown out. Weekend gold futures are up another 5 or 4%. Defense stocks are all limits up. Everyone's pricing in World War III. Everyone's pricing in the Armageddon and the apocalypse. Airlines are all down. Tourism companies are all down, in the red in the markets. Treasury yields are volatile. There's no bid. People are actually selling the treasuries instead of what they normally do, looking for safe havens. And your grocery bill obviously keeps going up higher and higher and higher. Now, your rent is obviously still coming, and the rent reset is going to be even more painful than it was before. Your pension fund is always going to be exposed to more volatility, and your currency is going to be debased. Now, in this world I'm talking about, did you get to vote on the monetary or fiscal policy? Of course you didn't. You didn't vote on the monetary policy. You didn't vote on the federal balance being in a deficit. You didn't vote on the expansion of the balance sheet. You didn't vote on the liquidity injections. You didn't vote on the bailouts. You didn't probably vote on your currency dilution. Of course you didn't. But you know what you are going to do? You're going to pay for all 4 of those things I just mentioned, because you are the buffer. As hard as that is to listen to, that's what your job is in this market, to be the buffer. And the system always protects itself, just like governments. The business of government is just to protect government.
Indeed,
now, why is the Middle East such a far-flung region of the world, something that's quite ununderstandable and unintelligible for many people? Why does that matter to the average person's wallet in Europe and other parts of Africa and parts of Asia and in America? Because right now, escalation risk in the Middle East is very, very real.
Oil transit through the Strait of Hormuz, Povik. Nearly 20% of global oil supply. That's not a headline.
Strikes between Israel and Iranian proxies, US involvement risk, regional expansion of the conflict, Red Sea, Strait of Hormuz shipping disruptions, oil transit, 20% of the world's flow going through the Strait of Hormuz being grounded to a standstill. Now, that's not the headline. That is what inflation truly looks like. Every single sustained $10 increase in oil historically leads to roughly 0.3 to 0.4 percentage points in inflation over time. And that can happen really quickly. Before your budgets can adjust, before your weekly expenditures can adjust, and before you can provision in gasoline at $5 or $7 in line of being able to afford your normal groceries and your rent, food, manufacturing, chemicals, plastics, utilities. You don't consume the oil naturally in its raw state, but you consume every single thing that oil touches, the logistical supply chain, all of the derivative products, the downstream products that come from oil, the energy that allows us to live the first world living that we're all accustomed and used to. And what happens when that energy spikes? Inflation expectations spike. It's not actually the inflation itself that is the killer sometimes. It's the expectation of inflation that actually kills the economy. People start to readjust. Bond yields move. People start to cancel holidays. People start to be more restrictive and conservative with their purchases. And suddenly, the central banks feel the political trap. Yeah, they might claim that they're apolitical, immune from political dispositions, but they're not. Because Rising rates are going to affect growth. They're going to affect political stability. They're going to affect social stability. And that's another place where the pressure leaks. And if you don't know how to combat it or how to see it, then you don't know how to position against it. There is only one priority in this economy when it comes to our overlords, our leaders, and it's debt. Let's zoom out. US federal debt, over 38 trillion, unfunded liabilities in the hundreds of trillions. Yes, trillions. Annual interest expense is at a conservative estimate $1 trillion per year and rising. That's more than most of the budgets in America. That's more than many countries around the world's actual GDP. And global debt is over $350 trillion. The system cannot tolerate sustained high amounts of rates without inflation chipping away at it. It needs it. So when the war risk pushes up the yields, the liquidity facilities, you better believe it, they're in the background quietly preparing right now. The swap lines are being arranged between central banks. Banks are calling each other saying, hey, we're finding dollar stresses here. We're going to need you to re-guarantee our supply lines. We're going to have you to re-guarantee the fact that we're going to be able to get dollars at a certain rate. There's going to be treasury buybacks. They're not going to call it QE, obviously. They'll call it market stabilization or a market stabilization fund. They'll call it liquidity control, but it actually is liquidity expansion. And liquidity expansion means currency dilution, not immediately, but structurally. That's what has to happen. War is going to create the volatility. Volatility is going to create the justification mechanism. No one is going to like to see their 401k plummet. It's going to create political unhappiness among the populace. So politicians are going to obviously do whatever it can to suppress that volatility because it's going to lead to votes being diminished. War creates volatility. Volatility creates the justification for them to do anything. And liquidity is going to erode all of the purchasing power once that justification inevitably leads to more printing, which is increased liquidity. It's the same cycle over and over again, different decade, different war, different political class, different administration, but the exact same cycle. Now, the spot market sees the pressure, the spot market reprices, but it doesn't do it as fast as the options market.
Gold call open interest expanding at strikes 10 to 20% above spot. That's not retail fear. That's institutional hedging of monetary instability.
The option markets, in terms of oil, you just have to look at the out-of-the-money calls for stacking above recent highs. Volatility skews are steepening. Volatility pricing is suggesting that something bad is going to happen. Gold open interest is ballooning out of this world. Silver, the same thing. Now, that's not retail fear per se. Retail doesn't have the kind of money to move those flows in the way that I'm talking about. That's institutional hedging of monetary instability. Because when the conflict rises, dealers have to move from positive gamma to negative gamma regimes. Negative gamma means they hedge into the strength, they hedge into the weakness. The volatility fills the volatility. As they sell more calls, they have to hedge themselves in the futures market by buying more things, and vice versa when they're sellers as well. So the volatility starts to feed the volatility, which is why we see these really ungodly, unholy moves happening all at once. Oil, limit up 10%, gold up 5%, equities down 10%, regional stocks in the Middle East down 20%. 3% days become 5% days, and then the frequencies increase and increase. The liquidity thins out, people get scared in the market, and the justification leads to liquidity. And retail investors are always the collateral damage. The retail investors are going to be the one that gets shaken up. Meanwhile, the institutional money are hedging the convexity risk, the asymmetry. The public experiences the chaos. The public sees all the price rises. The publics are the one who experience the rising of their grocery bills. But the professionals experience the opportunity. It's unfair, it's indecent, it's amoral, but it's just how it works in this system. That's not a conspiracy, that's not me making it up, that's just the mechanical structure. And if oil sustains these elevated levels, inflation is going to re-accelerate. Remember, every $10 sustained move in the oil price leads to about 40 to 50 basis points of actual CPI inflation rising. So what's going to happen then? The central banks have to pause the tightening at that point. There is no alternative in that scenario. The liquidity is going to have to seep back in through any other acronym. That means asset prices are going to rise, stocks are going to rise, home prices are going to rise, but your purchasing power is going to go down as they debase the currency, the unit of value. The populist reality is the only reality there is at the moment. The justification for more liquidity is the fact that we cannot experience pain. We have become accustomed to not experience pain in this economy, in this world. Everything has to be instant gratification, and any kind of semblance or scintilla or hint of pain has to be completely combated before it happens. Now, I don't know about you, but I don't control swap lines. I don't control sanctions. I don't control the legislative process to initiate a sanction or to release trillions of dollars into the economy. You definitely don't control the stablecoin legislation that's going to be taking over our world but isn't being spoken about. But you do absorb all of the inflation. You do absorb all of the pain. You do absorb all of the currency deflation. You do absorb all of the currency debasement. You do absorb all of the standards of living being eroded each single year. Central banks have purchased over 1,000 tons of gold because they know something that we don't know. It's the highest pace since the 1980s. They're not doing it because gold is back in fashion. They're doing it because they realize the debasement is real. The trust is eroded. The sovereign viability of sovereign debt markets is no longer viable. The energy exporters realize there are different settlement systems coming. No longer the petrodollar, but the stablecoin dollar.
Domestically, digital dollar rails expand, stablecoins grow, programmable finance grows, crisis accelerates financial architecture change.
That's not a rebellion. It's not some nihilistic, catastrophic, alarmist, anarchist kind of world. It's just pure, prosaic hedging. But what about what's happening in your hometown? What about what's happening in your city domestically? The digital dollar is coming for you. Artificial intelligence is coming for your job. It's no longer just a sci-fi experiment. It's no longer just a dystopian thought process or thought experiment. It's coming, it's here. The programmable money, programmable finance, it's growing in power. It's coming for your job, it's coming for your wealth, it's coming for your freedom and your liberty. Look, I'm not an alarmist. It's just the way it's coming. It always happens like this. Slowly at first, and then all of a sudden after a while. You're going to be told it's for stability. You're going to be told it's for the greater good. You're going to be told we're all in this together. But it's actually about control. It's about kicking the can down the road. It's about expanding debt. It's about concentrating power. It's about concentrating increasing wealth in the hands of the increasing few until war breaks out. Until instability happens, until revolution happens, until the people take to the streets and they can't take it anymore. But gold is the way out. Silver is the way out. Divesting out of dollar assets is the way out at the moment. Because the money supply is going to expand. And unless you're positioned, your dollars are going to be eroded. I don't care if you have $1 billion saved, if it's not in productive capital, if it's not earning you money that's beating the rate of inflation and also monetary erosion, then you're actually losing money. Because this is how the system works structurally. Financial repression is threatening everything we hold dear. Fiscal dominance is now shifting the government's mandate only towards servicing debt, not about your standard of living, but inflating the debt away. Think about the 1970s when there was a massive oil shock, the huge amounts of war spending, the dollar depegged from gold in 1971. That's not that far away. That's not that long ago. Energy plus debt plus war equals a monetary shift. It's always like that. We saw it in World War I, we saw it in World War II, we've seen it from the Ottomans, we've seen it all since time immemorial. It always happens like this. Each time the public are the ones who take the loss. They're the ones who take the L. We're the ones who lose the purchasing power. And who recovers first? The asset owners, the people who own homes, the people who own stocks, the people who own gold, the people who own supply chains, the people who are closest to the spigot, the monetary methadone. Those are the people. Different conflict, different time, different decade, different epoch, same mechanism, same outcome. And the system understands this cycle way better than any of us understand it. And that's why there is such a threat at the moment. And if you notice these cycles, they're getting quicker and quicker, faster and faster. The economic cycles, the economic booms and busts, they're getting more rapid, they're coming quicker, and they're experiencing way more pain each single time. AI is just the icing on the cake that's going to actually accelerate this even further, like gasoline on a fire. The capital is all rotating into defense, into energy, into AI plays, into hard asset, into domestic industrial supply chain robustness. Meanwhile, small businesses are all facing higher input costs, inflation, costs, rising fixed costs. Consumers are facing higher prices. Consumers are facing less choice. Their dollar is going less far each single time. Less far? Not a real phrase. It's going less and less. It's buying less and less each time. And the wage growth is stagnating. Wage growth is not growing in real terms. And the labor bargaining power is only going to be decreased as AI takes on full dominance. And mark my words, it will. If it isn't already, you're seeing the layoffs in the AI world. Companies realizing they can do the job of 20 with just one person who's good at AI. AI is going to suppress collective bargaining. AI is going to suppress labor power. It's going to suppress wage growth. War headlines are going to do one thing. They're going to distract us from the eventual liquidity shifting, the liquidity coming back in again. Missiles fly, the oil spikes, but your landlord raises the rent. How does that make any sense? The missiles are flying all around, gold's going up, but your landlord and your local grocer is just raising the prices. The system is going to call it resilience, but we're going to call it bloody expensive, because that's the truth of it. That's what it really is. All of this is interwoven and metastasizing, coalescing around our much vaunted by some and hated by others, our central banks, because they're in a real bind. They're in a catch-22. They're in a real problem right now. If they keep rates high during these conflicts, the credit's going to tighten. The recession risk is going to inevitably rise. But if they cut the rates, then the inflation risks are going to also rise, which is going to mean consumers are going to adjust their spending, the economy is going to slow down, things are going to tighten, and the economy is going to be less dynamic. If they do nothing, on the other hand, markets are going to destabilize completely. So they're going to have to do something. But whatever they do is going to have to be incredibly subtle. Liquidity through the exit, or through the back door, or through the side door, for want of a better phrase. Liquidity entered surreptitiously or clandestinely in a stealthy fashion. Treasury buyback, something like that. Stable coins backed by treasuries. Swap line expansions in a secretive way. Bank funding facilities. Balance sheet adjustments. Lower taxes. Lower rates. Something that helps to increase the liquidity flowing around the system. The oxygenated blood around the human body, for want of a better analogy. But effectively, it's going to be easing. It probably won't be called QE because QE has such negative connotations, but it is going to be effectively easing. You're not going to see a banner headline one morning like, oh, we're going to print $1 trillion to help you out. Or we're going to print $1 trillion platinum coin and we're going to put it against all of the debt, so write it down. It's not going to be like that. That's how monetary dominance comes into being. You're going to see the balance sheet is quietly expanding. It's going to be all about survival of the political system and survival of the debt first. Household purchasing power, your consumer power, your living standards, that's always going to come last. Even less than last, if that's possible. That's the last consideration possible. It's all about funding the government, making sure the government is a going concern. So who is really controlling your money? Because you better believe it's not me, it's not you, it's not us. We are not in control of our fate the way we think we are. Ask yourself this. Who actually sets global liquidity? Who controls how the money flows? Who controls who gets the dollars? Who controls who gets the pounds, gets the yen, gets the Aussie dollars? Who controls the cross-border settlement? Who controls the sanctions? Who controls the liquidity? Who controls the policy? Who controls the regulation? Who actually buys the treasuries in an auction that is increasingly untenable because people don't trust American debt? It's not voters. It's not people like you and me. It's not people who go out here every single day to earn a wage. It's not us. It's the institutions, the institutional frameworks that deal with billions and trillions on a daily basis. And those frameworks prioritize one thing: debt. Debt stability, financing the costs. They don't care about your cost of living. They care about debt, being able to meet the next payment, being able to carry it over, roll over the interest, finance the debt, and get, a bigger fool to buy on the next amount of treasuries, even though it's being debased by inflation and currency erosion when they're getting the money back eventually. But what is our experience on the other hand? Our experience is higher food, higher fuel, higher insurance, higher school costs, higher rent, higher medical bills. They experience expanded balance sheets, asset prices that keep going up, bond auctions that never fail. Those are two very different realities, but it's the exact same system. But it leads us to an inevitability. This isn't going to be chaos. It's going to be structural, a structural managed decline. High debt levels are going to require stimulus. They're going to require controlled payment flows. They're going to be requiring predictable cash flow systems, balance sheet expansion, where the promissory notes are actually backed up by people believing that the government can still pay. But the geopolitical stresses are going to exacerbate those issues. It's going to reignite the levels of distrust that we haven't seen before. Energy shocks are going to justify the intervention because no one wants their electricity bill to come up. And obviously no elected politician wants their voters to experience real world price of living and cost of living declines. So all of this volatility isn't just about the war. It's about your purchasing power. It's about your wallet. The resets aren't going to happen overnight, but believe me, it's going to come. It always does. And it always happens in cycles. It happens. It's inevitable. War is just the catalyst, but the writing was on the wall many, many chapters ago. This was inevitable. It was coming. This is just the catalyst for the eventual liquidity. And by now, you should now know where the pressure is going to eventually leak. Hopefully you do. Ciao for now. My name's Justin Banton. This is The House of Trade.